Well, good evening, everybody. Thank you for attending. Tonight, we're going to talk about discounted cash flow, which is one of those topics where we do tend to get faced with a big wall of numbers. Can be very intimidating. Hopefully tonight we'll strip away a bit of the detail and a bit of the jargon and get down to how it actually works, what it's all about, and hopefully we'll take some of the mystery out of it for you. So we'll turn the camera off at this point. You don't want to be distracted by me. Let's imagine you've got £500,000 going spare. That doesn't happen very often for most of us, but we've got some money. We need to decide what we're going to do with it. We can't just leave it in a tin on the sideboard because it's not going to earn anything on there. As it happens, to make the figures easier, let's say the bank will pay us an interest rate of 10%. If we put it in the bank, leave it in for a year, we'll have £550,000 plus 10%, which is we'll have £550,000. Notice the way I've worked that out is 100 plus 10 divided by 100. After 2 years, we'll have 550,000 times 110 over 100, we'll have £605,000. If we leave our money invested, the amount grows each year by 10%, and the way we achieve that is to use this factor of 110 over 100. This only works if we leave the money untouched in the bank, don't draw any out, of course. And from this we could deduce that if someone offered us £550,000 that they were going to pay to us in 1 year's time, we could say this is worth exactly the same as paying us £500,000 today. Likewise, if somebody offered us £605,000, which they're going to pay us in 2 years' time, this is also of the exact same value as £500,000 today. The reason for that is that if you receive £500,000 today, put it in the bank at 10%, it'll be worth just as much as the other two options after 1 year and after 2 years. The reason for this is if we have to wait for our money, we miss out on the interest it could be earning. So unless we receive more money in the future than the same amount today, it is not as worth as much. It might also be we've had to borrow the money to fund the project, so we're paying interest. So that's the basic principle of a thing that we call the time value of money. And let's look at some other jargon. We describe the interest that we have lost as our cost of capital. This is the figure that you'll be given in a question that equates to the potential earnings that your money could be making if it wasn't in the project. What we actually say is that with a cost of capital, or an interest rate of 10%, the present value of £550,000 received in 1 year's time is the same as £500,000 today. That's its present value, the present value of a future receipt. With a cost of capital of 10%, the present value of £605,000 received in 2 years' time is also £500,000. Now, we all know how banks work. Put the money in the bank, pays interest. Having identified, though, the mechanism by which we can measure those returns from the bank, we can use this same logic to put the present value onto the returns earned by other types of investment. When we invest money in a project that might be setting up a new business, it might be buying equipment for an existing business, it could be moving into bigger premises, it could be all manner of things. We put money into a project, the returns from that will typically come in over a period of several years. So we can use the technique we're talking about now to work out what that future income is worth compared to money today. Let's look at the relationship in mathematical terms between money now and money tomorrow. We look again at the interest calculation for our bank account. We said that £500,000 times 100 over 110 is 550,000. If we turn this round the other way, we get 550,000, the future returns after 1 year, times 100 over 110, the fraction is now the other way, is 500,000. So If we want to convert income that's going to be received in a year's time to its present value, if our cost of capital is 10%, we multiply it by 100 divided by 100 plus 10. We can do the same for the money that's coming in after 2 years. 500,000 times 110 over 100 repeated times 110 over 100, that's the second year's interest, gives us 605. Turn that round, 605 multiplied by 100 over 110, and again takes us back to 500,000. In accounting jargon, the present value of £605,000 to be received in 2 years' time at a cost of capital of 10% is £500,000. You're probably thinking at the moment that's a lot of fractions. The good news is usually we don't have to use fractions. What we do instead, we convert them to decimals. And even better, in most exercises you'll come across, these may well be provided for you, already worked out. Having said that, I think it's very useful to know how those factors are produced, because once you understand the mechanics behind it, this whole subject makes a lot more sense. So let's just work out some factors. If our cost of capital is 10%, our 1 year discount factor is 100 over 110, which comes to 0.909. 1 point here on rounding. In every case I can ever recall, we work to 3 decimal places. Now, if you're just working out 100 over 110 in your calculator, you'll find there are several decimal places. But round to 3 places, that's how the model answers in any exercise you do will have been worked out, and that's how you'll get a match. The discount factor for 2 years is the same factor repeated, so it comes out at 0.826. After 3 years, a third iteration, that gives us 0.751, and so on and so on. We've used 10% so far. The factor doesn't have to be 10%. More realistically, in the world at the moment, you're more likely to get maybe a bank interest rate of 4% if you're lucky. You might be able to borrow at that, possibly. If the factor is 4%, then we work it out as 100 over, again, 100 plus 4. So 100 over 104 is 0.962. For year 2, it's 0.925. For the third year, it would be 0.889. Very important point. Notice that if the cost of capital is lower, look how much less the discounting is. Those factors, the discount on the future receipts is a lot less vigorous. Future receipts are worth a lot more if the option of going to the bank and earning interest is a lot less. It makes the investment in the project much more attractive by comparison. What we normally do is, and this may be how the information will be presented, is we tabulate these factors. So here's a table. We'll put years across the top. Notice I've included year 0. That's now, that's today. The present value of £1 today at today's prices is £1. So the factor is 1. We include it so that we can use the same table and the same layout for every year, including year 0, the point at which the project starts. After 1 year, we said 0.909, then 0.826, 0.751. Don't worry about remembering these. We're going to make them visible as we make use of them. And year 5, so you can see the further into the future an amount of money is received, the less it is worth in today's terms. All very good, all quite fascinating, but what can we do with it? We put money into a project. We've said that the probability is future cash revenues aren't all going to come next week or next month. They're going to come in over a period of years. Chances are also they're going to vary a lot more than a nice steady flow of interest in the bank. After 2 years, there might be a huge influx of money. Then 3 years, there might be very little. 4th year might be good. So because the amounts are going to vary, we need to be able to take each amount of income and convert it into what it's really worth today. Once we've done that, we total up all the cash flows, starting with the money paid out at the start, or paid into the project, right up to the end when the money coming back ceases at the end of the project. And having discounted all of the future receipts, we call the final figure that we come to the net present value. There's a bit more jargon, NPV, you'll see this referred to as. The logic of this is that if we discount all our future receipts to their present day value, if having deducted from the total of those the money paid out at the start, if we've still got a positive amount, that's to say the discounted future revenues are greater than the money we had to put in at the start, then the project is earning money at a greater rate than the discount. It's not a case of making a profit, incurring a loss. Whatever discount figure we've got, if we get a positive NPV, we are earning at a greater rate. So it's earning more money than 10% interest at the bank. Another thing to think about, if our net present value is a negative figure, this means that the discounted future revenues are not worth as much as the money you have to put in to get started. Very important point and a very popular error. This does not mean the project has made a loss. It hasn't lost money. It means it is earning, but at a lower rate than the cost of capital. It means, if you like, you'd make more money by leaving the money in the bank to earn whatever the cost of capital percentage is. So far, so good. Let's now use this technique to look at a real project and decide whether or not the investment is worthwhile. Anybody who attended or has seen our payback calculation is familiar with Rogers Road Repairs. This is a company that does work for the local council repairing potholes in the road, so as you can imagine they're very busy. The company is looking to invest £500,000 in a new machine which will improve the efficiency of the business. The idea is that it will enable it to generate much better net revenues over the forthcoming years. We'll say that our cost of capital is 10%, and to keep the figures simple, the machine is going to generate a cash revenue, an additional cash revenue over what the business is doing now of £148,200. That's how much more cash will arise each year. So let's now lay out a table of the cash flows and the factors. And as I've already mentioned, the initial cash flow in year 0 is not going to be discounted because that is today. We're going to measure 5 items. We're going to look at the year, the actual cash flow, the present value factor or the discount factor, the present value of the cash flow, and then finally at the end we'll roll it all up together and find out if the net present value is more or less than 0. So we put the years across the top. Our initial cash flow we're going to pay out is £500,000. Year 1, 148,200 cash surplus is generated. Likewise, years 2, 3, 4, and 5. Now the factors that we worked out earlier. Year 0, there's no discounting because it's today's money, it's worth today's value. Anything that comes in a year from now will discount by a factor of 0.909, and so on across the figures that we worked out earlier. Present value of £500,000 paid out today is indeed £500,000. The £148,200, however, that's going to be received in a year's time, in today's terms is worth £134,714. And you'll see how the same actual cash flow is worth less each year. The further into the future that cash is going to be received, the less valuable it is because of the interest that we could have earned if we were paid it earlier. Now it's a case of taking that whole line of figures under present value, add them all together, minus 500,000 plus those 5 lots of cash inflow, we have a net present value of 61,678. That tells us, because it's a positive figure, if we're asked to evaluate this project on the basis of a 10% cost of capital and those figures, the project passes the test. The project is successful. If you like, it meets the requirement. The positive NPV at a cost of capital of 10% means the project is earning at a rate higher than the minimum required we've been given of 10%. If you like, you're making more money in this project than if you put it in the bank at 10%. So, assuming part of the question, the task you've been set, is to make a recommendation, you should therefore say the project is approved. But there is a catch. Generally speaking, an exercise like this will form part of a bigger task where you also have to evaluate the time it takes for the project to pay back that initial cash outflow, which was the subject of a previous video if you hadn't seen it. And it's very important that all criteria are met. So if you're told payback is so-and-so and NPV is another, the project has to meet all criteria. If one passes, the other fails, you should recommend to reject the project. It might not be that simple in real life, but in an assessment task, it's all or nothing, either all criteria or you must reject the project and recommend that it doesn't go ahead. And the own figure rule works on your side here. If you make a mistake in your numerical analysis, you must go with your figure, and if your figure, you actually come up with a negative net present value, even though it should be positive, you then recommend the project does not go ahead, you will get the own figure mark for that. And that, in simple terms, is how we determine a net present value when we are given the cost of capital, when we are given the cash flows. We can take this a little bit further though. Here's a clever bit. We know that this project is earning more than 10%. Wouldn't it be nice if we could look at all of these figures and actually turn them into what we could compare to an interest rate, so we could actually find out what rate the project is earning at? More than 10% is good to know, but wouldn't it be good if we could put a proper number on it? In fact, we can do. Time for a bit more jargon. The name that we give to the rate at which the project is earning is called the internal rate of return, the IRR. Now, this is a topic, everybody's scared of this one, it's nobody's favourite. It's actually not too bad if you know how to approach it. So, how do we calculate the rate that this project is earning at the IRR? We can't just put numbers in and magically work it out directly. What we can do, though, is redo the exercise we've already done, but this time using different rates of cost of capital. We've already said that if you have a positive net present value, the project is earning more than the given rate. It's earning at a higher rate. So what we do is we try another rate that gives a negative net present value, a much higher discount rate. And when we find that rate, we know that the project is earning less than this rate. So we know that Roger's project is earning a lot more than 20%. So let's redo the exercise using a cost of capital of 20%. Let's see if it's earning 20%. The factors, this time for year 1, 100 over 120. Year 2, 100 over 120. Notice it's always 100 plus whatever the percentage is, and so on. Let's put them into a table. Here are our cash flows once again. I've worked out the factors for us. 100 over 120 gives us 0.833. Multiply that again, you get 0.694, 0.578, 481, 0.401. As ever, the present value of the money initially paid out is its precisely the same amount. Our year 1 receipt at a much heavier discount is now only worth, in today's terms, 123,451. And you see the returns are very heavily discounted at this rate. If we roll all these up together, this gives us a negative net present value of 57,327. This means not that it's making a loss, but it means it is earning at a rate lower than 20%. So now we know this project is earning well above 10 and well below 20, because those are quite substantial figures, 63 and 57. It's somewhere well above 10, well below 20. Let's do it again. This time we'll try 15%. Once again, 100 over 100 plus 15 gives us 0.870. Repeat it, 0.757, and so on. Once again, put in the cash flows, put in the factors, and this time you'll see that the present values are not as high as when we used a 10% factor, nowhere near as low as when we used 20. And this time when we roll all the figures up, we get a very small negative net present value. From that we can conclude that it's a little bit less than 15%. We still haven't got an exact figure. Now, in the real world, quite honestly, this would probably be a plenty accurate answer to give to people making decisions. If we invest in this project, it will earn around about a 15% return on the money invested. If we want to go closer, you could do with 14%, then 14.5%. You can keep redoing it with the spreadsheet. It's not that difficult because if you set it up right, you're only changing one cell. Eventually you get a precise rate. You don't really need to do that, but of course, if you're a bit sad with numbers like I am, it actually is, in this case, 14.7285%. I know. It's the way I am. Let's now just do the table. Well, I won't do the table slowly. If we put that in, you can see that the present value is a little bit higher again than they were at 15. And sure enough, the whole lot balances exactly to 0. So we know precisely what rate of interest at the bank we would have to earn to get exactly the same returns as this project. Having said that you don't need to go to that degree, you might need to be asked to give a figure that is accurate, perhaps not the best word, calculated to maybe one decimal place. And there is a method we can use. What we can do, let's just illustrate graphically the relationship between cost of capital and net present value. Now, as the cost of capital rises, the net present value falls. If we look on here at a cost of capital of 10%, the net present value is up at round about 60,000. As we increase the cost of capital, when we got to 15, we can see we reached the 0 point. At a 20% cost of capital, it's considerably negative. So you can see that there's a relationship and an assumption that examiners make, and people who write textbooks, intriguingly enough, is that that line is straight. There's the point where you can see where we actually cross the 0 point. That is the actual rate at which this product is earning. But if we just move on, the calculation that you'd be expected to produce assumes a straight line, and it is the lower rate, which was 10%, plus how far it's got to fall, which was 63,000, divided by the total movement, which is 63 plus 57, about 120,000, times the percentage change from the low rate to the high, which was 20 less 10, which was 10. That's a bit of a mouthful, I know. 10%, the original positive NPV divided by the change in NPV, multiplied by the change in cost of capital, and that comes out at 15.2%. Notice the total movement is the initial positive plus how far negative it goes to give a total movement of 120 odd. Don't set one off against the other. Has anybody noticed a problem, I wonder? Because the question that springs to my mind is, why is it wrong? We've worked out by using precise calculations that the IRR is actually 14.7%. And yet this method comes out at 15.2%. And the reason is the graph isn't actually a straight line, much as it looks like one. I've got a copy of another graph with rather more exaggerated results that show that the graph is a curve. And if we put a straight line between any 2 points, and here I've got an example of one analysis at point A and another analysis at point B, you can see that a straight line will cross the line a bit higher up. That's about, in that case, that's nearly a whole % higher. We can improve things. You can see if we do 2 more samples at points C and D, get them closer together, then we will come out a lot nearer to the correct answer. But the good news is, in an exam, you're not expected to work to that degree of precision. You'll be given the high and the low rates to use, and you're expected to do that calculation. And just because the answer's not right, it will be the one the examiner's expecting, and that's what counts. That's the mechanics of everything you're going to need to tackle that you might meet in an AAT assessment, or an AAT task, or an assignment, or whatever. Just a bit of information about how this actually works in the real world, because I always think the more we can think about what the real world is like. In fact, the cost of capital isn't just what you can get at the bank. It's a composite figure. A business will work this out based on two things. The starting point is the actual finance cost, which is what could be earned at the bank. Alternately, it could be the interest you're having to pay at the bank, because a lot of money plainly is borrowed. And it is adjusted for risk. Imagine two different projects that you have to choose between. You've got one project, maybe you've got a chain of shops, well established, doing a roaring trade, and you decide to open another one in another location. That's probably a pretty safe bet. If the ones you've got are going to operate in exactly the same way as the new one, there's every reason to think it should do just as well as what you've got. So there's not a lot of risk. Alternately, if as the owner of a chain of retail shops, you decide to go into the manufacture of cardboard boxes, you haven't got a factory, so it's a completely new operation. It's very different to what you do. There's a chance you might not be very good at it. There's a lot more risk. So the idea is we will add an amount to the finance cost. If it's a safe project, we'll add a small amount. We might add 5%. If it's a bit more speculative, it's very risky, we might add 20% to it. This way, when we come to analyse the expected returns from the two projects, if the risky project has the potential to generate much, much greater returns, it may well still be chosen in preference to the safe one, but it will have to perform a lot better. This is a method that we can use to compare different projects with different levels of risk. If the results are similar, the safe project will win, because the lower discount rate means it's got a head start. It only has to finish out even in order to get the nod. But don't worry about that. You will not be meeting the concept of risk-adjusted discount rates, not at this stage. That's something you may meet a long way ahead in the future. I'm Jeff Grimston. Thanks very much for listening. Thank you to my colleague Alan for manning the chat panel. And remains to say, if anybody has any questions to ask, then the chat panel will remain open for a couple of minutes. Thank you very much.